This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
We are back.
No, we are all back.
Exactly.
For
all three of us in the room.
For the first time.
For the first time ever.
Did I earn my spot on the team?
I think you more than earned it, buddy.
Yeah.
But, it's been an interesting, volatile, I don't even know how many words we can use to describe the first half of this year, but crazy.
Pretty insane.
Pretty insane, to say the least. So we got a lot.
It's been a good year so far.
It's been a good year thus far, but we got a lot to dive into today. I know we want to keep it relatively short to keep the attention spans in check. But either way, we're going to give it off to Ken to start with his overview of the markets and how the first half has transitioned thus far. Chase is going to give us a little bit of a macroeconomic update, see where we stand from the health of both economies, our side, but also down south as well. And then just going to turn it over to me to kind of wrap things up, to give you guys a little bit of a sense of, what's really driving this market, but also most importantly, I think that the thing that everybody I think is after, and what's important to our clients is what is the strategy moving forward in the back half of 2026. So Kenny G.
Okay. Well, before we get going, I'm just elated to be here with the both of you. Both married men now. Congratulations, Cody. Look at those rings. Grandchildren on the way.
Soon.
Yeah, we just got
Chase
back
and I
from
have some planning to do.
You got. If you want to help me out with the financial plan, let me know. Let me know. They don't let me do much anymore.
I think we're covered in that department. Thanks, Ken.
But anyways, just trying to help out. But Croatia was a blast. Cody's wedding was unbelievable.
It was fun.
Yeah, 6 days in a row of straight socializing and partying. Long ways to go. Incredible place, but I'm still recovering.
Yeah.
Yeah.
Last time to Europe?
Probably last time to Europe, yeah.
That's why you left all the chargers and the adapters.
All the chargers, all the extra euros. They're all yours, buddy. Anyways, I'm just looking at us. We're all kind of dressed the same here, and not that you can see it on the camera, but we all have our loafers on with no socks.
I feel a little bit underdressed, though. I should have put on a suit. Sorry, guys.
You're
but
looking good. You're looking good. It's summertime.
Right?
It's hot
Anyways,
outside.
it's a delight to have us all together for the first time, and maybe you guys could do a little reflection, because if you remember back in elementary school and high school, I pulled you out of school every time to come down to Marine Drive to hear me speak. I think it kind of paid off.
I think it did too.
Yeah, so let's dive right into it here. So what an amazing first half, and what the market tends to ignore these days is unbelievable. Look no farther than today with Trump putting new bombings on Iran. I think there was 120 targets that they hit. And what happens with oil today?
It doesn't move.
It doesn't move. Actually, was the last time I saw it was down $1.50.
Yeah.
So, the geopolitical risk here is certainly being ignored. I think a lot of the trade barriers that the world is facing now are being ignored. You've got concentration like we've never had before. You've got the top 10 names making up 40% of the S&P 500. And, you've got this sense of complacency where investors are looking beyond all of this. And when you look at the numbers for the first half, I find it fascinating. I don't know too many people in the world, when we're in the middle of an AI technological boom, that would have ever guessed that value would outperform growth by 11 full percentage points. I certainly didn't see that coming. I certainly didn't see the Mag 7 at 1%. Certainly we'll talk about that a little later in the presentation. And then you look at small cap, Russell outperforming the S&P 500 2-1. You got the Canadian marketplace beating the S&P 500 by 2-1. So it's a really interesting dynamic time. And I can say that to the clients that it's a good job that my boys are slowly relinquishing my duties. And what I mean by that is when I got back from the desert after a couple operations, I went into my office and all my monitors were gone. So they now have 6 monitors on their desks.
Relinquish the technology from
yeah. But I think technology is, I reflect back and I go back to 1999, 2000, 2001. Nick Magini and I had the best returns probably that we've ever had, out beating the market in those 3 years because we didn't understand technology. Mm-hmm. But now I think the clients are very well placed because you guys have a complete handle on technology, what AI is doing, the data centers, all the power that it takes to this. And I look at it and I did some research that they did a survey at the beginning of the year. Mm-hmm. It said people that are over 65, 20% had at least used ChatGPT once. Mm. And only 1% have used Claude. So I think it's a big mistake. We got lucky in 1999 to 2000 to 2001. But having you guys at the helm is, I think, critically important because this AI, from what I see, could only be in its infancy stage.
Couldn't agree more.
Yeah.
And I don't understand it, but what I really like about what you two are doing, it reminds me of the old Smith Barney commercial where it says, "We make money the old-fashioned way. We earn it." And that's exactly what the two of you are doing with our clients. You're earning their trust. You're earning their loyalty because your knowledge is incredible in these areas. I was going through my slides with Chase, and I was going to talk about, I was talking about the geopolitical risk. I was talking about the concentration, talking about the trade barriers. And I was going to say that, valuations are stretched. And Chase quickly said, "Dad, you can't say that because that's not true." I'm going, "Well, Chase, if I look at the Shiller PE ratio, it's at close to an all-time high like it was in 1999. And I look at the Warren Buffett indicator, and he said, "Dad, but the Shiller PE ratio doesn't count forward-looking margin appreciation."
And it averages a 10-year average of earnings.
Right. So I had to chat GPT it, and my son, you were right, thank you. But the reality at the end of the day is still that for that to be true, the earnings margins have to continue to grow. And if they contract, I guess that's a bit of an issue. So anyways, guys, well done, and thank you.
Well, thanks for the compliment.
Well, don't kick me out quite yet. I'm not ready to leave.
No, you
quite yet.
you got a lot more time left.
Oh yeah. Just no monitors in my office. I'm not allowed to do anything. I'm not allowed to give reviews anymore. Just phone the clients and say hi. Yeah. I'll do that. Anyways, this is a long-term value indicator looking at the percentage of assets that individuals have in the stock market. And as it's very widely used and a very popular indicator. And what you can clearly see here is we're getting close to 50% equity allocations for U.S. households. And the bottom line is, in this chart, is any time we've had peaks, like in 1974, you take a look at 2000, 1999, the tech bubble, you go all the way over right here to the financial crisis. Anytime we've had this huge surge, it is always the next 10 years, the subsequent returns are usually below long-term averages. So I think that's something to pay attention to. I mean, this is pretty incredible. I mean, you take a look at margin debt right now at 1.42 trillion. And people just don't like to talk about debt, but debt can be a challenge. And there was only 3 periods going back all the way to 1997 that we had a bigger number than we do today, which stands at 54%. So you go back to the tech bubble, it was 80. You go back here to the financial crisis, go over. Interesting, the March 2022. Don't forget that in April, during COVID, we saw the market drop 35%. And then in August, it recouped everything, the shortest recovery in history. And that's why you had this sense of euphoria going on in 2021. But I think it's interesting to see at those 3 peaks, it definitely had an effect on those 3 cycles. Will it happen again? I don't know.
Yeah, it just goes to show you once markets are in a positive momentum state, and people think that momentum is going to continue, why not leverage up?
Oh,
right.
Yeah,
and so that's what you're seeing.
I think
and it's the epitome of what happens at all-time highs.
Alan Greenspan,
right?
irrational exuberance.
Yeah,
I don't know.
exactly.
Kind of reminds me back in the day.
And those are classic behavioral signs that you have to pay attention to. So,
and then you take a look at leveraged ETFs. Now, this move here so far in 2026 for the first, that is unprecedented. I mean, look at the slope of that's basically going straight up. And so now the amount of money that we have in leveraged ETFs is absolutely crazy. And, some people say it's not a big deal. Okay. As of the end of June, there is now $16 trillion in ETFs in the United States in totality. Go back 5 years, it was 7.2 trillion. So it's more than doubled in 5 years. Canada had record ETF sales in June and now has surpassed the 1 trillion mark. So you take a look at the current leverage and Chase gave me this slide, and what he's alluding to is these single stock ETFs where 90% of the transaction are by retail investors that are using option strategies to double and triple their leverage.
Yeah, they'll have a margin account and then they'll buy like a 3x long single stock ETF.
Yeah, and the single stocks, the number one is
so it's
NVIDIA.
leverage on leverage.
Yeah, it's NVIDIA, right? And then it's Tesla, and then you've got Google and, the rest.
Yeah, you got like Micron now and a bunch of the semi players.
And so, people, it's, in some sense, it's like a casino. You don't have to leave your house to gamble.
Yeah, but the problem with that, I know this is a little bit off topic, but a lot of the providers in the United States, like the Robinhoods of the world, have you ever looked at one of those platforms? Like the trading platform
Well,
itself?
they just came to Canada, and now they're branching out.
It literally is gamifying the entire stock market. It's like it's a casino. So it's concerning, and from, again, a behavioral aspect, those aren't very good lessons to be teaching, especially the younger investors, that this is kind of their first time ever dealing with investing, right? So
the younger investors have really never seen a down market or a prolonged bear market.
Yeah, so
and so some people say, okay, well, there in leverage ETF, there's an astounding 210 billion. So the bulls say, don't worry about it; it's not a big deal, right? Because the leveraged ETFs at 2.10 billion divided by the 6 trillion, there's only 1.3% of the ETF market that's in leveraged ETFs. But at the end of the day, I still believe it could have an impact at some point in time. I mean, what's going on with the IPOs, the secondary offerings, the primary offerings? Absolutely crazy. I mean, SpaceX first day of value was $2.66 billion. And then you have Amazon at 2.65.
Yeah.
Okay? And so one day raised $85 billion. Yeah. And that is just astonishing. And I said billions. That's
it's bigger than Amazon.
But this is trillion, not billion.
No, I know
Yeah, it's
that.
$1 trillion market.
But
Yeah.
what's interesting, last year's SpaceX for 2025 revenue, I think they did $18.7 billion. Amazon did in 2025, I think it was $716 billion.
Yeah,
So
SpaceX has a higher market cap.
Exactly.
It's more amount.
So you can just
Yeah.
see the speculation from investors
And
about
like the speculation is out there, and then everybody rushes to get the IPO. And if you were lucky enough to get the IPO, but take a look at the 30 major IPOs in the last 15 years. There's some big names there. There's Facebook, there's Google, Spotify, Shopify, Zoom, Uber. The reality is year one, sometimes can be pretty damn challenging. And if you've got an average drawdown of 55%,
they get cut in half.
you could get cut in half. And I don't know what it kind of looks like the Empire State Building on the left-hand side, right? But this is SpaceX, going from the issue price of $135 to over to $200 a share back to 151. And what really cracks me up about this is and when I was in university, I actually did a study on new issues, and I've never been a fan of new issues, but it's always interesting to see what the underwriting group says before and after. So Morgan Stanley just put out a report the other day that says they see SpaceX going to $200 by the end of the year. Raymond James didn't give a time frame, but they said SpaceX is going to $800 a share. I guess Raymond James wants some more bigger allocations next time.
Well, especially with the equity unlocks that are happening.
Well, and that's what we're going to talk about right now. This is unprecedented.
Didn't see your slide.
Yeah, well, there you go. That was a great segue. So you got $85 billion for SpaceX. You've got
Anthropic.
You got first of all OpenAI.
Yep.
Right, that's $40 billion. Right. You got Anthropic, which is $30 billion. Then you've had secondary offerings like Google, because they're spending all the money on CapEx. They're at $90 billion. And then if you take secondary offerings and primary offerings so far this year, they're at $600 billion, all record paced. So where's the money going to come from? I also wondering who's going to buy all this stuff, right? And you've got it. This is at a time too where corporate buybacks were first 6 months were $925 billion, a new record. Everything's a new record. So some of it just
you could argue for SpaceX some of the funds came from Bitcoin, and then maybe some of the Mag 7.
Sure.
Yeah.
And then here's part of the reason why the Mag 7, only did 1%. And again, it's that they are spending huge amounts of money. Right now, I just did the research yesterday. Meta and Microsoft are basically on their CapEx 90% of revenues. Amazon and Google are at 75 to 85. And these companies prior to the CapEx spending had enormous amounts of free cash flow. Now the game's changed. They are spending so much money. Look at what Meta's doing, okay? Did you hear what they're doing in Alberta?
Yeah, they're opening a data center.
A data center that is, put that in perspective, it's going to be larger than Stanley Park.
Yeah, I think it's $13 billion that they're investing.
Yeah, $13 billion, but the size of the facilities is going to be bigger than Stanley Park. Go figure. The important thing to understand on this chart, and the reason why investors have sold off parts of the Mag 7, is because they're wondering if this is going to pay off. But if you just follow the red line, you can see going up to the end of 2024, that red line peaks, and they had enormous amounts of total free cash flow. And now that is fallen off a cliff, and investors
these
are
businesses
wondering.
have come from asset light to asset heavy now.
Yeah, exactly. And so this is the interesting thing. I mean, take a look at AI. I mean, take a look at that slope. And, I honestly think, I remember the dot-com boom, and I was just saying that, hey, we got lucky, we didn't understand it. I think the AI could be very different. I'm not here to say, but I'm just, don't want to be repetitive, but I'm glad you're steering the ship, because I don't think a lot of our clients understand how the impact of AI, and it could be in its infancy stages.
But that's the thing is nobody knows.
So
Nobody knows.
everybody always says to me, they say, well, what do you think the catalyst is? And if we're going to get a market correction, and very few people could ever guess, but I'm sticking to my guns. And in the last several podcasts, I always talk about debt, and nobody wants to talk about debt because they don't think that's a problem. But at the end of June, total world debt, including government debt, corporate debt, and household debt, reached an astounding $353 trillion, a new record. From 2016 to 2026, debt worldwide has grown by 60%. A lot of people believe it's not a problem because you've got all these long maturities. But what about inflation? There's a lot of risk to these scenarios.
Yeah, no, it's definitely a black swan event.
Yeah.
It could hypothetically happen. But predicting a credit crisis, which 2008 being a credit crisis, it would be an absolute devastation.
And that's not going to stop us from investing today. That would be
and that's why I'm here, because Chase thinks I'm always bearish.
Yeah, you can stay in your bear cave.
I am not bearish. If I see the positives.
Yeah.
I can see the negatives, and so at this point in time, I'm neutral, and we have to be in this game because this could last a lot longer than people think.
And it's good to have a difference of opinions.
Yeah,
right?
no, exactly.
Well,
between all of us, the whole point is we don't want consensus of thought. Right?
No.
And that's the whole point.
And
is
if we look at the
just that some of my thoughts aren't really that archaic. I know you guys think they are, but
they're not.
Yeah.
If we look at the .com bubble, and they were laying fiber optic, all the companies were anticipating demand to show up. And demand didn't show up for 4 or 5 years later. The difference,
and they weren't making any money.
And they weren't making any money. So you had all those companies that laid the fiber optic essentially go broke and out of business. What's different now is demand is outstripping supply.
Yeah, sold out.
And so that's a big difference between this capex boom and the .com boom.
Yeah, and Michael Burry's saying that the amortization of the 5 years, the going thing. Do you know that they're actually selling the used in 5 years' time? They're actually selling the used chips for actually more than what the companies paid 5 years ago.
NVIDIA's Blackwell chip is lasting a lot longer,
incredible.
and on the secondary market, it's going for a premium.
No, but it's still this is still a very, very important slide that you have up there that shows all these different boom and bust cycles, right? And not to say, and I have a slide on this, but not to say this time is different. But if you are contrasting it with one of the most recent ones, the .com bubble, like Chase said, is the big difference there.
90% of companies weren't profitable.
Yeah, exactly. So you have three big comparisons between .com bubble and now. The players in the .com bubble were small, unprofitable, and untested companies. Now, yes, the free cash flows of Microsoft, Amazon, and NVIDIA have fallen off. But those are still trillion-dollar powerhouses.
Yeah.
Very different. The other aspect, too, is you have immediate, this is what Chase was speaking to, you have immediate utility of artificial intelligence.
Yeah.
Unlike the .com bubble, where literally the only thing happened is when a company started up, let's say pets.com, the only thing that they were really getting was traffic to their website. They didn't have broadband. They didn't have monetization of anything. it was just traffic.
Yeah.
Whereas now, if you have immediate utility, the companies already have cloud infrastructure, Azure, all of these different things to have revenue immediately. And that's what makes it, I think, different.
Yeah, I agree.
But just because it's different and it's going to change the world, like we've always said, is the price you're paying today inevitably the correct price?
Oh, it's changing my life.
And nobody,
ChatGPT is my best friend.
Nobody in the entire world has that answer.
Yeah, I agree.
And I think it is a very big mistake to bet all your chips one direction or the other.
Costly.
Absolutely. On both sides of the equation. You could miss one of the biggest bull markets ever in history if this thing does take off and the expectations are met and surpassed. But if they're not, and we do see the flip side, that is also extremely painful, right? It's the trillion dollar question that nobody has the answer for, and that's why I think I'm going to get to it. Sorry to elaborate here, but I thought it was a good point.
Very good point.
Is that's where you need to be disciplined about, number one, stock selection, the bottom up, implementing your research into the individual names that you own, why you own them, and the revenues coming forward and the earnings coming forward. But most importantly, the biggest thing at the end of the day becomes the asset allocation. And yes, we are exposed to some AI companies. That is for sure. If you look throughout the portfolios of the individual names, you can take a look at them. AMD already up 180% in the portfolio. ASML, TSM, a whole bunch of names that we believe are going to be the infrastructure layer behind artificial intelligence. Are we chasing some of the memory names at this point in time? No, we're not, because I feel like there's a little bit of overvalued nature in some of those. Yeah. So it's not like we are ignoring it. We're very much a participant, but also on that side is if the story does become very pessimistic and it does blow up, we're not completely exposed. We have fixed income. We have Canadian equity.
You know, Cody,
we have all of these other things because, and this is the final point I want to end on, we are not here to be chasing returns. We have always been essentially stewards of capital for our families for generations to come, to provide a required rate of return for our clients to live their lifestyle and not blow their lifestyle out of the water if things actually did go south. That's why we're here, to be the discipline.
Well, that's why you're the bus driver. And I'm glad that you've taken over driving the bus. The luncheon is going to be on October the 14th. And don't forget, I do have a bus driver's costume. So if you'd like to wear that at the luncheon, now that you're the new bus driver.
Fantastic.
Yeah, probably fit you.
Yeah?
Yeah. Yeah.
Gained a little bit of weight or no?
Okay, Chase.
Okay.
Let's rock and roll.
Sorry about that.
No
I thought
worries.
my slides will go by very quick now.
So switching gears here, just want to give our outlook on what's happening with the economy, both in the U.S. and Canada. But before we get into the details of that, just quickly want to highlight what's transpiring with oil prices. So on the last podcast, Cody and I said we weren't that concerned about where oil prices were because usually oil supply shocks are temporary and prices eventually do decline. So
I know it's not too early to celebrate, but were we pretty accurate?
We said we believed oil peaked.
Yeah.
And so since then, oil has basically dropped from $110 a barrel to around $75.
Yeah, it hit 120 at one point.
So we're close to pre-war levels, which is fantastic because that's going to help things on the inflation front.
100%.
But it seems like things are changing by the minute.
Yeah.
It seems like the Iran peace deal with the U.S. is blowing up.
I know oil is flat today, but it was up 10% over the last 2 days, so we have had a little bit of an uptick.
We definitely have.
Changes moment by moment.
But I still believe that oil prices have peaked, and this is going to bode well for the inflation picture on both sides of the border. So if we just look at Canada's inflation and we look at the headline print, doesn't look that great. In May, it ticked up from 2.8 to 3.2. But if we look at the core measure, which excludes food and energy, we're sitting at a core reading of 1.6. So this basically says there's many areas of the economy at this point in time that are in excess supply. And what that means is the Bank of Canada, based on these numbers, is not going to hike because you haven't seen a pass through from higher oil prices to core inflation, which is an important thing to note. So our base case
and that's exactly what we said last podcast, right? The immediate impact of an energy crisis like that, the pass-through effect is literally 10 basis points or 0.1%.
exactly to
right?
core inflation.
And kind of what we're seeing here, again, it's changing by the moment, but still a good sign from a rate hike perspective for the Bank of Canada.
Absolutely. So bottom line is we're not concerned about the inflation picture in Canada. We believe it's peaked. We believe interest rates have peaked in Canada. And then, like I said, we also believe oil prices have peaked. Now, we did have a technical recession in Canada, right?
It was only a matter of time.
Yeah.
We were. How
Right.
long have we
Yeah.
been presenting Canada's hanging on for dear life? Like the amount of times I've said that in these podcasts.
Well,
so,
it came to fruition.
Yeah.
Yeah. So the textbook definition of a recession, as we all know, is 2 negative quarters of GDP growth. But what I want to highlight here is it wasn't a consumer breakdown. Okay, the consumer actually grew in the first quarter, not by much. But the reason why we had that contraction is we saw business investment fall off a cliff. We saw government spending fall off a cliff. And then we saw our trade deficit increase significantly, right? And most of that has been a result of trade uncertainty.
Oh, yeah.
And if we tuned into what happened on July 1st,
Who's no more?
well, essentially they didn't opt for the full 16-year extension.
1 year.
They now instead an annual review every year. So things haven't really changed that materially because 90% of our exports to the US are still duty-free. But those tariff sensitive areas like the lumber sector, aluminum, steel, those still have those hefty tariffs on them. So that's definitely going to continue to be a headwind for
sure.
the Canadian economy.
For sure.
Right? I think the biggest risk I see is when it comes to business investment in Canada. If you're an entrepreneur, you can deal with bad news and you can adapt. We saw businesses adapt in COVID. But when policies are changing year by year, it's very difficult for entrepreneurs to plan and invest. It's difficult for them to invest in Canada. It's difficult for them to hire more people. So I believe this uncertainty is definitely going to continue to be a drag on the Canadian economy.
Agreed. Because how do you position yourself? Obviously, we deal with
When
uncertainty every single
on
day.
On a 1 year review when Trump can change his mind whenever he wants.
Yeah, if the entirety of your business is trade derived, that is.
And there's a lot of situations where it is.
It is, of course,
right?
of course, especially being it's such a resource-centric country, right?
Yeah.
So
absolutely,
it's difficult for sure.
We look at the business investment, right? It's on a standstill.
I thought it was getting. I thought it was supposed to get better.
I know.
Not
Look
even
at
funny.
Look at
That's so
No,
not even
why are we
funny.
laughing?
Look at the divergent. My point here is we can't blame everything on the tariff policies, and we can't blame everything on Trump. We got to take some sort of accountability and say, okay, maybe our policy environment in Canada has not been the best, and it hasn't supported entrepreneurs.
Amen.
It has not supported risk-taking, right? We look at our regulatory environment. We look at the massive lead times to get projects approved. And at the end of the day, we haven't had a major project built in Canada in a very long time, right? So it doesn't just come down to Trump. It comes down to who we elected in the first place.
Yeah, the lack of ability at home.
Yeah.
The lack of ability at home. And we've seen, this is why you take a look at some of your American peers, your American friends, and you're like, wow, seems like they're doing a lot better down there. And I know they have their problems, and we don't need to get political about it. But if there's one chart to sum up this, and the GDP per capita is the exact same as business involvement, probably correlation of almost 90% there. So I think it's time to start looking at home and seeing how we fix it here, because it's not a pretty picture yet again.
Not at all. But Ottawa seems to be taking a different stance, a pro-growth stance they're taking now to invest in our energy infrastructure, our electricity capacity, and our defense spending, right? So there's a lot of new initiatives and projects that are being put forth. It's just a matter if they actually materialize.
Exactly. And like I said, when Carney got elected, I said he brought that list of basically what he was going to bring to Ottawa and everything that's going to come forward. But then again,
But
It's a
you know,
politician.
I mean,
it's a politician speaking.
I mean, I know the world's not at peace, but do we actually need 15 submarines now? You know, like seriously,
well,
50,
he had to do that to please Trump, because Trump wanted everyone to spend 5% of their GDP on military defense.
Yeah, I get that. I get that because Trudeau never got there.
Yeah.
In all those years.
But I think it's important that we have a strong military.
Oh, I'm not agreeing. I just don't know if 15 subs is.
I think the story is it's probably long overdue.
It's long overdue. I think.
Well, considering we only have 3 and there's only one that works,
and
it doesn't work that well.
No.
It seems we can't trust Trump anymore, so we might need to focus a little bit more on our military.
Yeah. No.
Okay. Yeah, no question.
Yeah. Okay. Again, it's not all bad news in Canada. There is some signs of hope. If we look at National Bank's estimates of GDP growth, they actually have it rising to 2.3 annualized at the end of the second quarter, where we see around 14 out of the 20 sectors posting increases. So that's some good signs there. We also look at the labor market. We had a rough start to the year, we were saying on the first podcast, Cody.
Yep.
But we fully recovered and had the strongest job gains in 17 months worth of data.
Yeah.
So
that's a big. That is a big reversal from where we were. It's just whether the trend sticks.
It's not all rain and clouds.
No.
In Canada, there is some pockets of sun. So I remain optimistic that the Carney government will do the right things to support growth in Canada, and it's just only a matter of time to see if it materializes.
Yeah. We'll be sure to check in.
Yeah, that's for sure. Okay, moving on to the U.S. Wow, resilient on all levels. They're firing on every single cylinder.
Yeah, I think the risk at this point is almost overheating.
Yeah,
to be honest.
Seriously.
Yeah.
Look at the economic activity. One of the ways we gauge economic activity is looking at the PMI index, right? Purchasing Managers Index. And for the clients that don't know what this is, essentially it's a monthly survey that is sent to businesses, asking them whether they're selling more products or services, and how are overall business conditions. Are they improving or are they contracting? And if we see the dotted line here where it says 50, anything above means there was an expansion in economic activity. Anything below it means there was a contraction. We look at the manufacturing sector in June, the number was 56, the strongest reading in 4 years. Yeah. Obviously, can be explained by the big CapEx spending, but still significant.
Yeah.
You look at services, it posted a reading in June of 52, the strongest reading in 4 months. So the economy is thriving on all cylinders.
Yeah, for sure.
We then look at the consumer. Resilient again.
Yep.
Right? Consumer spending growth is growing around 4 to 6% annualized. Every metric we look at, Costco sales, credit card data, the retail control, which is from the Census Bureau, the consumer
and
is not cracking.
No, and the consumer is being helped by the growing stock market, and the rich are getting richer.
The wealth effect.
And the wealth
the
effect.
CapEx and the beneficiary from those dollars.
They got more money to spend.
I know. Well, look at the upper K. The upper K of the economy. We've talked about this at length about the wealth effect. They're still spending.
Yeah.
Right? Try and get a reservation anywhere. You and I've talked about it.
Oh.
Virtually impossible. I wanted to take my wife for a nice steak dinner on Friday. Looked to book a reservation on Monday. Nothing. Can't get anything booked on
No, I know.
Yeah.
Friday or Saturday. So just look at hotels. Look at hotel stocks. Hilton, Marriott, Hyatt. Absolutely ripping. Right?
And even if you take out the period of COVID over here and just take a look at the growth from here, it's astounding.
Yeah. No. It's huge.
And this is the consumer that matters to the stock market and the economy. And I'm not saying it's necessarily right, but that's the reality of the situation we live in right now.
And we've talked about that at length, right? And just to explain to clients that didn't hear it to begin, the U.S. is very much divided where the top income earners are making up the majority of the spending, and they're making up the majority of the stock market essentially as a whole. So when we talk about a K economy, we have the top class driving it, and unfortunately the lower to middle class being
the top
behind.
1%
Yeah.
of Americans own 50% of the S&P 500.
Yep. Makes sense. But there's more and more people in the U.S. joining the upper middle class, which is a good sign. More people are getting richer. It's easier today to make money than ever with like the technology and the resources we have today. So
yeah, and they also have a lot more of an entrepreneurial spirit down in the United States than here at home.
I think you have to, because back in the day you could go to school, get a good job, get a good pension, and you'd be okay. It's different times.
It's different times, but that's also why a lot of people are frustrated too.
And why you
right?
see the speculation with the 25-year-olds buying single stock ETFs, right? So it comes full circle.
It does, but who knows?
Okay.
Let's not venture. We can go on a tangent. I'll be quick with my slides.
Okay, moving on here. The U.S. inflation picture is a lot different than Canada. We've said for quite some time the U.S. has been a lot more resilient than Canada, meaning they haven't needed as many cuts as Canada. But we expect this to come down with what we're seeing with oil prices. But we still believe inflation is going to be relatively sticky because of the massive AI boom we're seeing right now. The demand for memory chips is unprecedented. We've seen what has happened with Micron, Samsung, SK Hynix. They're the best performing stocks of the year, right? And the challenge right now is that AI data centers, the hyperscalers, are competing directly with laptops, tablets, and iPhones for the same memory supply. Okay? That's a problem.
For Apple.
So I want to read you what Tim Cook said, CEO of Apple. You know he's retiring.
Yeah.
Right?
Yeah.
John Turnus is the new guy. He's apparently
I
a
heard
hardware guy.
Mm-hmm.
So this is what Tim Cook said. Tim Cook called Apple memory cost crisis a 100-year flood, forcing a 20% price hike on select Macs and Apple models. So now your iPhone Max just went from $1,700 to over $2,000.
That's a problem for Cody because he always loses his phones.
No, I've been better over the last little bit. Come on.
I don't think so.
No.
I was telling Cody to kind of get off topic. I was like, it's going to be interesting to see once this all sorts itself out. Do you think Apple's going to lower its prices again? No.
I don't think so.
That's going to go straight to their profit margins.
But those memory stocks have made up a tremendous amount of the attribution too over the last couple of months, especially year to date. You take a look at Micron, you take a look at SanDisk. Some of those names year to date, believe it or not, are up over 800%.
Yeah, I know.
And just the one concern about the memory to say, well, yeah, we can see the supply-demand shortage here. But unlike a NVIDIA chip, which has a lot of competitive advantages, AMD, they have their own little things. Really hard to differentiate yourself in terms of memory.
Absolutely.
Quite honest,
That's a really good point.
And so it's hard to see those, like for investors to see those rates of returns and see Micron. If you looked at Micron today, Micron is up 12%. It's hard to look at that and not chase, right? And a lot of people are chasing it. It's momentum-fueled place right now. But I think that's where, you know what? There's no competitive advantage to be had that's going to be durable. And the earnings per share growth is not going to be durable. That's the kind of analysis that you need to undertake. Right?
Yeah, absolutely.
And so there are pockets of the AI which can be very speculative here.
Absolutely. One last point I want to read here.
Yeah.
Micron's HBM supply, their high bandwidth memory chip, is entirely sold out through 2026, and in some areas the company can only fill 50% of customer demand. Right? So this is obviously going to cause some inflation pressures and make things a little bit more sticky and hard for the Fed.
No, definitely.
Right? So because of all those inflation drivers that we just mentioned, the market has went from pricing in 50 basis points of cuts at the beginning of the year to now pricing in a 25 basis point hike. Okay? But the question is, do we care about hikes as stock market investors? And yes, we care about hikes, but we care about the magnitude of the hike, right? Because everyone assumes that, hikes are just generally bad for the stock market.
Oh yeah. God forbid, don't tell that to a realtor. They'd be like,
Yeah. But that's not actually
Are there
true.
any realtors left these days?
I don't know.
No, they're
It's
falling by the wayside.
It's tough. I feel for them.
Yeah. So small hikes, believe it or not, are actually bullish for the market. And if we look at the middle here and we look at these two quintiles, this shows hikes anywhere from 25 basis points all the way up to 100 basis points. And the odds of the stock market advancing from those hikes is around 83%. That is very, very high.
And what's funny is the aspect that if you compare that with a 25 basis point cut, or 25 basis point to a full percentage point cut, it's actually lower.
Yeah.
Right?
Yeah.
And it kind of goes against the mentality that most investors had is, oh, if there's a hike, that's bad because the risk-free rate has gotten higher. It's going to compress.
Well, the economy is
Good
strong.
because the economy is strong.
Exactly. Right?
They weaken it.
If
lower
they weak, it means there's a little bit of trouble brewing, right?
Mm-hmm.
But like you said, it's the important thing here is it's the magnitude of the direction of the hike, right?
So if the Fed got really hawkish really fast, that would be a concern.
Exactly.
Right?
Right. And that's what we saw during the fastest hiking cycle
in
ever
2022.
in 2022.
The last point I want to make here is, does inflation have to go back to the 2% target for the stock market to do well? And history suggests no.
Mm-hmm.
The sweet spot for equity markets is actually when inflation is 3 to 4%, believe it or not. Think about why you invest in equities as an inflation hedge.
Mm-hmm.
The problem, and when you don't want to own equities, is when you've got a core inflation reading of 4.5 and inflation is still driving higher, right? Our core reading right now in the US is 3.4. You look at the average 50-year inflation rate in the US is 3%.
Yeah.
So, can the stock market continue its bull market with inflation at these levels? Absolutely.
Yeah. And I think it's just, as we've talked about at the luncheon, it's just we've entered a new regime of inflation.
Mm-hmm.
Yeah.
Inflation is going to remain elevated. Gone are the days of 1% inflation that happened post-Great Financial Crisis.
Yeah.
But that does not necessarily mean it's a bad thing for equities.
No. So, that's my little spiel.
Fantastic.
Well done, Chase.
Thank you.
I'm going to do a quick check over there. Carm, how much time do we have?
We're at 143.
Okay. Fantastic. We will get through this relatively quickly because I want
By two?
By two? Yeah, probably.
Okay.
No, I'm going to do it quick because I had my little side piece that interrupted yours, which covered actually a lot of what I was going to go through. So, apologize for interrupting you, but we'll make this relatively quick because there's a lot of points that we've already gone over. First thing, just want to give a quick rundown on the market yet again. Very positive first half, despite all things. We look at the Toronto Stock Exchange, all the global indices. Ken's already been through this. Good results, but it's obviously been a very, very bumpy go-round with a lot of different market narratives happening over a 6-month period of time. So we take a look at this slide right here. It shows you the bar represents the range of returns for a given market. So we have large caps on the left, where we see at the top, up 11.2% was the peak for the year, but also it in the given year was also down 7%
in March.
Yeah, exactly. Yeah. Down 7.3% in March. Then it fully recovered, and the diamond blue is where the return is at the end of the quarter. Okay? So obviously we've seen a lot of narratives. The Iran conflict is what drove a lot of those indices to have the deep decline. As Chase and I presented on the last podcast, we presented in the beginning of the year that we were neutral, but we did take advantage of that conflict and weakness in the market to roll over some of our Canadian equity to beaten up large cap stocks, which, as you can see on the U.S. side, that was a 14% flip.
Yeah.
Huge, tremendous. But the moral of the story is
took
some profits on the Canadian side to roll over into the U.S. Good active management there on that front, but still a lot of different market narratives going on. And it seems like if the first couple of days of July is anything to say, it's going to continue.
Yeah.
It's going to continue. So just on the U.S. side, we're seeing a lot of broadening out happening. Ken's already kind of spoke on this. The Mag 7 is only up 1% as the end of the quarter, but basically everything else to the Mag 7, or the 493 names, are making up a lot of the story.
But what's interesting is in the first half of the year, the equal weighted S&P outperformed the S&P 500 by almost 2 full percentage points.
Yeah, I know. So you're seeing some broadening out, and it just comes down to that Mag 7 story of the free cash flow, right? But you also have just plenty of groups working, from obviously semis are very much related to artificial intelligence, industrials, transport, small caps, micro caps, regional banks. You got a lot of things working, which in the grand scheme of things, if we have to just put it in layman's terms, a broadening out is healthy.
Yeah.
And usually industrials and transportation confirm a healthy bull market.
Exactly. I'm going through these quick. Don't worry. Quick recap on Canada. Okay.
We won't comment.
No, you can comment. You
We
can
won't
comment.
go
I
off
just
on a tangent
no.
like
I
Cody.
know. Sorry.
That was you, not me.
Quick recap on Canada. Really, the only thing that's been, I would say, really driving the Canadian marketplace at this point has been the banks and energy companies for the first half or the first quarter of the year.
But as a contrarian, look at gold, eh?
I know, but what were we saying about gold in the
beginning
beginning of the year? Yeah, gold we said was a speculative trade at this point in time.
Look at it now.
And look at it now, but some people were a little concerned because gold was up in the beginning of the year. February, it was up 40%, but then we had those large corrections, right? But it is having a pretty big drag, gold, on the Toronto Stock Exchange, because we've seen banks have some of the best rates of returns almost ever.
Yeah.
Almost ever. But it's becoming a little bit much on the Canadian side. Like the valuation from price to book, if we compare the Canadian banks with the U.S. banks, at one of the largest differentials ever on record. And so, not to say that something is necessarily wrong with the Canadian banks, but could there hypothetically be a pullback? And has it been overstretched? Probably. Probably. But just banks leading the way on the Canadian side. So just want to dive into it. We kind of already chatted about it, but if we just had to sum it up into 3 key things, what's driving the bull market in the United States is these things. Number 1, capital expenditures. Ken already went through it. Companies, especially the Mag 7, are pouring billions to trillions in totality, but billions individually, into everything. Yep. And that's having a substantial impact on GDP and is essentially having just a tremendous impact.
Yeah, and
overall.
why you're seeing the broadening out in the S&P 500.
Exactly. Because it's trickling down to
and small cap.
It's trickling down to other industries, right? So we're seeing that CapEx, but also another thing that's driving this is we're also seeing a substantial amount of earnings growth. Substantial amount of earnings growth. We take a look at this graph, which the baby blue line shows the S&P 500 price, and then the blue line that's a little bit more smooth shows the consensus 12-month forward price or earnings per share. Okay? And what is the key thing that we always say about stock prices?
Follows earnings growth.
If we think about the single most important driver of capital appreciation of a stock over not a 1-year period, 6 months, but over a 5-year period, the single biggest driver that makes up share price is earnings. Yep. And it's a good sign. It's a good sign. But the question becomes and people have been asking the question, are analysts getting a little bit
lofty with their expectations?
Because this is consensus 12 months forward.
And
right?
that's where a bubble could be burning within the analyst expectations.
Exactly.
Because can these companies keep meeting these high hurdles? Yes, they've actually surpassed them, but they can't do that forever.
They can't do it forever, right? And that's where I think people are deeming it the analyst bubble. There's a lot of bubbles being thrown out, but still. But if those targets are achieved, if the stock price is to follow, the S&P 500 is to follow earnings like it has over the past, and it's the single biggest driver, there could be more room to come from here. And beyond earnings, another thing that's just driving is the immense amount of margin growth happening. Companies are a lot more profitable, and we've seen such a large margin expansion. We take a look at the left-hand side of this graph, which shows the S&P 500 profit margins over basically dating back to 2002. Look where we are. Yeah. The S&P 500 has never been more profitable. So these are the three things that are really driving this bull market. But what's funny is, I've had a couple conversations with a lot of clients over the phone, especially in Canada. It does not feel like a bull market. It does not feel like a bull market to a lot of people.
I think you can blame Instagram and social media reels for that, because the algorithms force you to see all this violence and hate, and
yeah,
that's probably why.
Clients hopefully not watching.
No,
that.
I hope not.
So,
yeah.
But you also have news channels that are totally one-sided too. So
yeah.
But it just goes to show you, like, I'm not making this stuff up. That doesn't feel like a bull market, because if we take a look at the consumer sentiment index in the United States, how the U.S. consumer is feeling, we are at basically bottom recessionary levels. Look at where we are on the right-hand side, June 2026. We're at a level of 49.5, okay? That is worse, almost worse than November 2008.
that is crazy.
And yet, we're at all-time highs. So it doesn't really feel like your bull market, right? And there's a lot of things that I would say make up that. Number one thing being is there's a lot of uncertainty, from geopolitics to, God, the list goes on and on, right? So if we take a look at the World Uncertainty Index, yes, it peaked out when we had the Iranian conflict ensue in March. We've come off a little bit, but look how elevated we remain, right? Extremely elevated. So it's still very much an uncertain landscape. And I also, what I think is also adding to the level of uncertainty in it, not necessarily feeling like a
This guy's been wrong for so long.
I know.
Did you see that
I know,
interview?
but he's doubled. He's doubled down.
Yeah,
He's doubled down.
He's been wrong since 2010.
I know.
I don't listen to him anymore.
I know. But
He's been so dead wrong.
But
I
there
feel
are-
sorry for the guy.
I know.
Like, I've never seen a guy that's been more wrong in my entire life, and he's one smart cookie.
He is one smart cookie.
So to earn his credibility, he's doubled down.
He's doubled down.
Yeah. Him and Michael Burry probably had lunch together last week.
Yeah, but there are still the reason why I bring this up is why it also doesn't feel like a full-blown bear market is I would still say there's a lot of institutional and private wealth managers that are on the bear side, to be quite honest with you, right? This time is different, as you've said multiple times, Ken, before, are the 4 most dangerous words in the English language. There's a lot of people that obviously still believe it. And I see those concerns. Yes. There's no doubt about it, right? And I'm not going to read through...
You just sit there and say, this time it is different.
Yeah.
And you don't have...
But to miss,
to miss out on this AI, I think the risks are more of missing out than the...
Yeah.
So you're going to miss out on 90% of the upside, and then when it falls 30%, you're going to say you were right.
Yeah, and so that just goes to show, like, if I just, and this is what's causing a little bit of the divide yet again. We have the bears like Jeremy Grantham at GMO saying the U.S. stock market has now been in a bubble territory for a prolonged period of time. You know, at this pattern leading to market euphoria, then to overinvestment, and thus severe market declines is repeated again and again throughout history. And he just continues on, and he says, what is more likely is that the deflating of the AI bubble will lead to a major stumble for the economy, a plunge in profits, and a severe decline in valuations, right? And so what Jeremy Grantham and a lot of, I would say, hard value investors are saying is this time is not different. And that's just continuing to beat the drum. So you take a look at that, and obviously some of your points do point to Jeremy Grantham's side, and there is obviously some concern from a historical perspective.
Going one way and being a bear for that long is you would have blown your clients out of the water.
Yeah, exactly. And that's where we have the quote on the right-hand side by Adam Parker, which takes the bull's point of view. And I think I'm going to read it because I think it's a very good quote to read here. So this is the bull point of view. He says, what bothers me about investors is the oppose that it's never different mantra is that they project an air of intellectual superiority and laugh at those who say it is different this time. We are not saying that human cycles of fear and greed don't rhyme. We are not saying that hubris and debt aren't always present at tops. We are not saying that behavioral science and finance isn't critical. But when it comes to AI semiconductors, my response is, it is already factually very different at this time. Sure, when there is inevitably or eventually a large drawdown in profits in the stocks, these people will feel intellectually vindicated, but that doesn't matter. If they think AI is a joke and the hyperscaler capital spending is all stupid and the memory stocks are the biggest bubble they have ever seen, they are already brutally wrong, and they have already been massively different. Waiting for the cycle to turn lower to justify that you were right to miss a large portion of the biggest upcycle ever doesn't make sense.
That's beautiful.
So
I love that.
And it just goes back to the famous quote that there has been more money lost anticipating a bear market than actually in the bear market itself.
Yeah, and so it's these really I would say both the bulls and bears for this point in time are really clashing. Really clashing.
I like who you chose here.
I know. Poor man
Poor
was
guy.
on
From
CNBC.
68, he's got to be like 98.
He was right in the tech bubble though, right?
Yeah, and he was right about the Japan in the 80s as well.
I listened
right?
to him on a podcast, and he said he lost a big portion of his clients because he was wrong for so long.
Yeah, and they never came back. But that's the risk you take as someone managing money for a living, right? And so the one thing I want to just talk about here is, you know what, I'm going to wrap this up quickly. I'm sorry.
Okay. You've got 3 minutes.
Okay.
You're good.
Artificial intelligence. Why? I'm not going to say this time is different, but we need to highlight some things here, okay? We've shown this slide before, which shows on the left-hand side the length of task AI agents can autonomously complete, what it takes a human to do, okay? And we said that little blue dot at the top, which is Claude Mythos, the preview, the newest model of Claude, that wasn't on the slide before, but we said that these things are going exponential. They're only getting better and better and faster and faster. And you can see now it can complete tasks in a matter of minutes that would take a human 3 hours to complete with 80% accuracy. Massive. But the most important aspect that we've been talking about, if AI demand is real and is the free cash flow investments or the free cash flow that these large companies are taking and pouring into CapEx, is it going to be worth it? Comes down to adoption. Mm-hmm. And what we're seeing is businesses using AI in any business function is gaining traction, and it's gaining traction heavily. Fast. You look at all these different business functions, from information all the way down to financial, insurance, real estate. The average in June 2026 is 21%. And that's going to grow yet another 5% over the next 6 months. Mm-hmm. Huge. The adoption is coming. And doing and fooling around with AI and doing the research that I have a very stark opinion that if you do not adopt, it's not a choice anymore.
Yeah.
I said if you do not adopt, you are going to lose out dramatically as a company or as an individual not utilizing it.
Absolutely.
The power it has from an efficiency aspect is immense. You've democratized knowledge.
Yeah.
Why it also looks a little bit different is this is not your pets.com. Remember pets.com when it went?
Yeah.
Yeah. In 2000?
Yeah.
Okay. So Anthropic, you said, is coming out with the IPO.
Yeah,
Okay.
30 billion.
30 billion. I think
Probably be more than that.
So it's still a private company, but
Yeah.
there's not really, everything gets disclosed now. Even if you're private, they
Yeah.
can still find out what your revenues are. But we take a look at Claude and the amount that it has gained in terms of its revenues over such a short period of time. Okay? Because the demand is real. You take a look at Claude's revenue in December, annual recurring revenue in December 2024, $1 billion. $1 billion. 1 year later, $9 billion. We fast forward now 3 months, just the first 3 months of this year, their annual recurring revenue went from $9 billion to approximately $20 billion. And you're telling me that that's fake? When they have all these metrics behind there, that is immense.
You've never seen
anything. You've never seen anything like that.
But I think what would really help, not on this podcast because we're running out of time, but when we were in the desert and you were there for a couple of days and we had the opportunity to sit down and chat, you explained to me how you use Claude for helping for your research and how you set all the parameters as a CFA and how you can put all these research reports in. I think on the next podcast, you should take 5 minutes and explain. Do you think it's a trade secret?
No, it's not a trade. It's not a trade secret.
I think our clients would really appreciate.
It's the quantitative overlay that happens.
The depth of understanding that you have, and how you're using Claude and AI.
Using Claude, using AI, using our own intellectual capacity to take the manager's selections, quantitatively test them, and also verify.
I think you should do that in a separate podcast.
That would be.
Stay tuned.
That would be a long.
It's
that would
really
be a
good.
long. That'd be a long one.
But Code,
Chase and I won't talk to you now.
For the bears to call this a bubble, and we haven't even got to the humanoid robots yet. Like I'm saying, you people laugh at that.
No, but it's.
But think about factories. Think about you getting.
I know, Chase, it's not going to happen. One for my condo.
You don't think you're going to get one to do your chores?
No.
I disagree with you. I think adoption will come. It might come slowly, but I think it will be there.
It will be there from all industries. I think, like, you take a look at surgeries happening in the United States. Intuitive Surgical has the Da Vinci machine. Like, robotic surgeries, no longer you're a surgeon that once you don't have a steady hand, you're gone.
That's exactly what happened with my knee replacement and my
But it'll all be
tunnel
done. It won't even be done by a doctor.
It's not
anymore.
happening.
Yeah.
It's not happening in Canada.
So if you had a robot that made your bed, did your cooking, cleaning, you wouldn't pay $20,000 for that? I think that'd be more valuable than a car.
Probably scare the hell out of me.
Thing walking around at night? Yeah, it's a little crazy. It's the whole thing about innovation. You just got to get used to the little new things that come about. Okay,
well, maybe I should get one because you guys aren't going to take care of me when I'm older, so I'll be on my own. Yeah. So
okay, let's wrap this up.
Yeah,
let's wrap this up in terms of what the overall strategy becomes for the back half of 2026. I'm going to make it really short. We said at the beginning of the year that we were neutral. That stance for the back half of 2026 remains the same. Ken's gone through a lot of the concerns. I've showed you why this time might be different. But one key thing, if we just look at, just from a valuation perspective, if we were neutral in the beginning of the year, well, we took a look at where valuations now are compared to the beginning of the year. Valuations across basically almost every single market are cheaper because earnings have been growing. That within itself is a big portion of why we want to remain neutral.
They said on CNBC this morning that NVIDIA hasn't been this cheap from like 5 years ago.
Yep. Yeah. And so like I said, we know the risks. We can see them. We're not immune to it, but we're also not blatantly just rejecting AI because of those risks. We have AI, but also then again, we're not all full AI at all. At all. We have great, powerful businesses that don't have anything really to do with AI as well. And so it comes down to that security selection. The asset allocation, again, remains neutral, but we have that fixed income. We have the alternatives behind there to where if those risks do come to fruition, we have dry powder at our disposal. We're able to eliminate the volatility on the downside. But most importantly, and I'm going to say this, is throughout the next 6 months, pretty sure that we're going to get something that feels like a bear market. I think we're going to get a correction. And what's happening right now specifically is there's been a breather since the top in June, right? But I think we have to approach as long-term investors, stewards of your capital, we approach those moments like we did on April 1st when we transitioned from Canadian equity to U.S. as an immense buying opportunity. And you can't take advantage of a buying opportunity if you don't have the correct asset allocation in place. And that's what we still maintain as the core discipline of our investment strategy.
And I think that's why clients, can't be looking at the underlying benchmarks.
Yeah,
the benchmarks are not your portfolio.
The benchmarks are not the portforlios, and the concentration has become crazy because if I put 40% of our clients' money into 10 names
and it goes the other way,
well, bye-bye financial plan.
Look at the Korean markets. They're dominated by 2 names, 60% of the index.
Yeah.
Samsung and SK Hynix.
Yeah, and that's a very good point. I think with the concentration that's happening, benchmark construction and comparing benchmarks has gone by the way.
There isn't an active manager that can beat the benchmark
when
there's 40%.
Exactly. Like you can't have names in your portfolio, in a US portfolio, sitting at 19% of your overall exposure.
Yeah.
That is not good risk management, and we're not here to do that. If you want to just own that solely and swing for the fences, for sure, but that does not lead to, I think, steady compounded returns that last 10 years. And that's what we're here to do. So I appreciate you bringing up that point because
very good point.
They're out of the wayside with how things are concentrated, right? So
and if you want to discuss that in more theory, Cody's a pretty busy guy. I'm not as busy anymore because they don't really let me do anything. But you can still call me, and I'd be very happy to explain the comparisons of why you shouldn't be looking at the benchmarks relative to your portfolio.
Yeah, exactly. So the last thing, because this podcast is beyond the noise, we want to end with one quick lesson. I know, but we are basically at all-time highs, a little bit off. But I think this is just a key point to just end on, which says, you know what? What happens, if investing at all-time highs, it deters a lot of people from investing. Mm-hmm. You see all-time highs, you're like, you know what? I'll wait for a pullback. Sit in cash, feeling fine. You know what? Might get better. What's interesting to notice if we take a look at the right-hand side there is we have 2 bars over different time periods. The gray bar shows you investing on any day over a period of time, and the green bar shows you investing at a new high. Okay? And so what's funny to note is, over the first 3 months, investing on any day beats investing at a new high. But if anytime we stretch that out further than 3 months, investing at a new high actually is better than investing on any other given day.
Mm-hmm. Well, look at 6 months and look at 1 year.
Look at that. No, exactly. Look at 5 years. Investing at new highs over a 5-year period of time, you would have done 82% versus 76% on any other given day.
Wow.
And that just kind of goes to show you, in a world and a stock market that's changing, it's for sure changing.
Oh, tell me about it.
There's a lot of momentum. There's a lot of momentum happening. And momentum carries one of the largest factors in determining rates of returns moving forward. And some things you don't want to fight is the momentum.
You and I talk about this all the time. Would you rather buy a stock that's up 100% or a stock that's down 50%?
Yeah.
Most likely your better odds are buying the stock that's up 100%.
Exactly. So key lesson of the story is don't let investing at all-time highs scare you. If this chart's any doing, it's actually better for you.
That's a great chart.
Yeah. Mm-hmm. Yeah, but just counterproductive to what everybody thinks. So just last admin items, performance reports are coming. Ken is going to be giving some calls. I'm going to be giving some calls. We're all going to touch base. Wealth notes are coming. And then most importantly, we are having our luncheon on
the 14th of October. And Chase is going to be speaking too.
Am I?
Yeah.
There we go.
You're doing such a good job, Chase.
Yeah, exactly.
Yeah.
3 Musketeers now.
3 Musketeers.
I love it.
I love it.
Well, thank you guys all for watching.
Thanks for tuning in.
Thanks for tuning in. If you've made it this far.
Have a great summer.
Yeah. And
we'll definitely talk to you. We're going to do another podcast just before the luncheon, so in around the 12th of October, for those of you that can't make the luncheon. Yeah. But please mark your calendars for October the 14th, as we'd love to see you down at Marine Drive.
Thank you so much.
Thank you.